Michael, thank you so much, and for highlighting also a couple of key considerations. One of them is ease of access and management, but also that brand and that reliability. Now, when we talk about those two things, you might assume that we're talking about what I'm going to describe as more developed and conventional assets. But nothing could be further from the case. Please welcome my panelists who are going to talk about emerging markets to the stage. And among them, Lawrence Hulse, who is Investment Director at Dowgate Wealth. Welcome to you. Rong Rongpo, who is the Executive Director at 91. Eric Martineau-Fortin, who is founder and Managing Partner at White Star Capital. And Rosie Wardle, co-founder and partner at Synthesis Capital. Hi to you. And as you will discover, they all have very interesting stories to tell. Lawrence, we'll start with you, if we may, right at the end there. In times of uncertainty, from my limited career as a banker, but and watching the financial markets, you tend to find that funds repatriate quite often to more developed markets. But there are these strands of emerging markets or non-conventional markets which are enduring at the moment. So, Lawrence, what are some of the emerging assets that are now considered, in some cases, less risky than one might imagine? What's attracting your eye?
I'm going to be very careful not to use the term less risky, given I'm sure there's finance teams in the room. But certainly in terms of accessibility and availability and being better understood, I think back to an earlier part of my career at a business called Gresham House. They very much pioneered two asset classes I'd flag today, which would be one, battery storage, and the other is UK commercial forestry. Both have a real sort of two-facet approach where they have both massively outperformed equity markets and provide diversified returns. I think the energy storage fund they floated, and by definition was very accessible because it's a listed company, floated on a 7% yield and has delivered NAV growth as well to supplement that. And then the forestry has been doing 20% per annum. But actually, at the same time, it's doing good for the world and has a positive externality. Battery storage is key for renewables because it smooths out the sort of power volatility. And forestry, of course, sort of speaks for itself in terms of green credentials. The one thing I would add, though, in terms of emerging asset classes that are priced riskier, what's quite interesting, my background's very much UK smaller companies and UK listed businesses. And despite being one of the oldest asset classes I'd probably wager in the world beyond sort of fixed income, they're now priced as if they are a really risky asset class. I think the UK now sort of trades at a discount to rest of world equities of not seen for 40 years, which back before the time of TEL, SID and the real accessibility of public markets in the 80s and 90s. To have an equity market on less than 10 times PE in a country like the UK is quite surreal. So it's priced as if it's an emerging asset class, which is quite unusual, I'd say. But it is now emerging. To the other point in your question, there are signs now, despite a lot of negative headlines around asset allocation to the UK, there are signs of that generational discount to the rest of the world bottoming and closing, and rightly so. The UK, the Channel Islands are both fantastic places to do business. I think the UK market has the highest proportion of 10x return stories out of any market in the world, and I think the UK has produced, and the Channel Islands, more unicorns than the rest of Europe combined. So bizarrely, you've got a very traditional asset class now behaving like an emerging one. And I think that's real food for thought, I must say.
Just quickly, you mentioned battery storage. I think we can all understand why that might be a place that would attract investors. What about forestry?
Well, it literally grows in value for you. I think they have a phrase, store on the stump. The trees grow about 5% per annum biologically, and actually, as they age, a bit like a decent red wine, the value accretes sort of slightly exponentially. So they're a fantastic asset class, and I think they have very good tax treatment in the UK as well. They are from recollection, and this is not tax advice, obviously, IHT exempt. I think the timber harvesting is income tax exempt, and the capital appreciation on the trees is capital gains exempt. So a really attractive asset class and very different.
Okay. Eric, let's come to you and ask the same question about what asset classes are attracting your eye.
I think I would not look at it from an industry standpoint, but more the type of financial products that we have to come up with in this current environment. I mean, a number of you know White Star now after a few years, but we invest in technology companies internationally, so we help them grow fast and across different jurisdictions. And it goes from fintech to digital health, some food tech, some mobility, logistic, industrial automation, future of work. So that's what we do. Now, what we found, and since we've spoken last year, is that the market is quite terrible when it comes to pricing companies with equity. And I think anyone that has investment in company or raising capital now, if you're not profitable, if you don't have any EBITDA, it's virtually impossible at this stage to raise capital the same price you raised capital 12 months ago, 24 months, even 36 months ago. So with this, it creates a very complex equation where you need to fund your company to make sure that they remain sustainable for 12 months, 24 months. And at the same time, avoid pricing them, because this market is still quite bizarre between private equity, unlisted companies, and public equity, which is now starting to hit probably a normal level. And what we've seen, and that's a report I read this morning from CIBC, it happened to be a Canadian bank. Some of you know I'm Canadian, but I read this morning. We see that the private market is starting to arrive close to the public market level, which is an interesting sign that it might be time to go back into the market, but it's still unclear. So as a result, we came with a new product, and we're within weeks of announcing it. And this is something we structured out of Guernsey. I mean, it will be based in different jurisdictions, but out of Guernsey with our team, we have now 10 people in Guernsey that is helping us manage the firm. And we're going to come up with a new fund called Structured Growth Equity, which is, for some of the experienced people in this room, a bit of a progression to what junk bonds was, and then high yield bonds were, where we would enter into non-profitable company with a loan product, with having the possibility to invest in equity, and adding up a number of complex features in it, such as like multiple points liquidation preference, interest rate, and equity warrants, and different type of structure like this. And I think that's quite a good product at the moment. It's secure your return without capping it, and avoid pricing companies. And that's something that we've seen entrepreneur as well as other co-investor being quite receptive to. And that's something that we think it's quite promising for certainly the next 12 to 36 months.
Right, just to clarify, why is it particularly applicable in this economic environment?
Well, I think if you try to raise money now, you're going to have a number of investors that are not ready to dilute themselves in light of the alternative, and they're not ready to invest either. So you have a situation where you either crush a cap table for the founders, or you crush the cap table for early investors. And in this one, you're just giving yourself a shot for another 24 months to make sure that as market come back, you taking a risk that others are not taking, you securing a return. But if you are delivering on the business plan and on the expectation, then in 24 months, some early investor that paid a higher price than they should have paid might still be made whole and continue that story. So I think it's just a way of extending the runway. Venture debt is doing this, has done this for a number of years. I think venture debt become very expensive now. This is also an expensive product, but you take more equity risk. And I think that's probably where the market is as well.
Interesting. So enticing investors back, it's an innovative way of doing that. And you've developed that. And how long has it taken you to develop that in Guernsey?
It's been around 12 months. I think the collapse of Silicon Valley Bank has been extremely useful for us, because it limited the number of opportunities. And we saw this couple years ago, the two managing partners that will be running this strategy for us, that are experienced lenders were for another firm. I can mention it now because it's going to be in a few weeks announced. But they've been lending to a couple of our portfolio companies through a venture debt product with equity warrant in it, and they were allowing themselves to invest part of the capital in Series C, Series D round. And we felt that if they do it against us, why don't we get them to join us so that we can do it as well into the market? And it probably around 18 months between getting everything regulated. And the regulated advisory company is based based in Guernsey. But we will have a combination of vehicle between Luxembourg and here to run this in order to be able to land on a...
So Silicon Valley Bank really worried investors is what you're saying, and it wasn't a question of the depositors you're talking about there.
I think it's not that it were investors. To be fair, the Silicon Valley Bank collapse, especially for Europe, it's not the result of the bankers at Silicon Valley Bank that were lending. They all did a fantastic job and they were the best and continue to be the best in the market. I think it's a good acquisition from HSBC. I think it's an issue with the asset liability allocation at the headquarters that led to that collapse, not to the loan that they've done to companies, because they were always very, very well structured.
Good, thank you. Okay. Right, if we could now come to Rosie, and if you would tell us a little bit about synthesis and why this is a very enduring asset class at the moment.
Yeah, of course. So Synthesis Capital, for those who don't know, we are a venture capital manager and we're specialised in the future of food. So we have quite a narrow focus thematic. We're early stage venture, so Series A and B is where we write the majority of our checks, where we take board seats, lead rounds. We've been doing this for about 10 years now, so really since the industry began back in around 2013. Prior to setting up Synthesis, though, I ran with my co-founder at Synthesis a family office of a private equity investor called Jeremy Collar, who I'm sure many of you are familiar with here through Collar Capital, who also has Guernsey domiciled funds. And we'd been investing, as I say, from that early point of the industry with his family office capital, and we decided to set up Synthesis about 2 years ago as a spin out of the family office to essentially leverage more external capital. We are based here as an investment advisor in London, but our fund is Guernsey domiciled. We're also accredited as a Guernsey Green Fund, which is great. And we closed the first fund last summer on just over $300 million. Just to explain a little bit more about what we actually invest in, we primarily do technology, which is essentially creating a more sustainable food system. For us, that's very centered at the moment around replacing animals as a production system, a very inefficient production system, and getting rid of factory farming, which, as we all know, is driving a lot of the global challenges that we face now in the world. So within that strategy, anything from plant-based foods right the way to cultivated meat, so growing real meat directly from cells without the need for the animal. So there's a lot of crossover with both agtech and biotech. We are financial return first as a fund, but we do believe that in our strategy, it's one of the rare areas where you truly do get impact intertwined with financial return, because we're investing in companies that we hope will be the kind of multinational food businesses of the future. And maybe just a word on kind of how that our strategy, I guess, has evolved over the past 10 years that we've been investing. And I think for me, that kind of speaks to and illustrates the value of being a specialized fund, which I think is becoming more and more popular with LPs, at least we see that, is that we're able to really kind of constantly evolve our strategy, investment focus as the industry emerges. And in these very new nascent industries, that is key. So to give you one example, when I was at the family office of Jeremy Collar, we were early investors in Beyond Meat, which was a fantastic return for the fund, for the family office. Now we don't do any more CPG plant-based brands, because for us, they were a first mover, they kind of had their day, it was a great IPO for the early investors. Now in terms of the Synthesis strategy, we're very much focused on B2B opportunities up the value chain, protectable, differentiated technologies where we see real kind of platforms emerging that have the potential to really drive a paradigm shift in how we think about producing food. So I think as a specialized manager, we're able to keep ahead of those trends and pick the winners as we move forward in what's a growing sector.
Rosie, I think that's fascinating, because at the beginning you were saying what you were talking about it not being as established, and as this sector becomes more and more established, of course the technologies move on to new things, and plant-based food, you're saying, is not what that's kind of old tech, as it were.
Well, there are some companies within plant-based that we still believe have a really strong future, who are kind of next level of replacing meat. So there's a company called Redefine Meat that we've invested in the Synthesis portfolio, which is available in London actually in some restaurants. And that's incredible. You can barely tell the difference to an animal steak. They actually 3D print meat and steak. So there are some companies that are really demonstrating really cool technology that I think will appeal to a mainstream audience, which is the name of the game here.
When is it going to become usual to go to a restaurant and have that as the main agenda?
I think it's accelerating now. So I think within the next 5 years, those types of products, which really would appeal to a meat-eating carnivore, will be regularly available in restaurants. And in kind of 7-8 years, we'll have cultivated meat on the shelves and in restaurants as well.
Because that's presumably what you watch very closely, because that ultimately is what defines the space.
That's the real thing. Yeah.
Yes, fascinating. Fascinating sector. Plenty more to talk about there. Rong is also there, waiting to share her story. She's from 91. And contrary to what you might think, that is not the year in which I was born. It is the year in which your company was born.
Thank you, Tanya. So do you want me to kind of add
Yes,
a
if
bit
you would
more?
just talk a little bit about 91 and where that came from.
Thank you. Thanks for asking. I'm grateful to be here. So 91 used to be called Investec Asset Management. For those who love sports, will recognize the zebra. So during pandemic, we demerged and then luckily got listed on both London Stock Exchange as well as the Johannesburg Stock Exchange. So simply, we are a global independent asset manager. And so far, we're very lucky that we have around $200 billion US. So building on the questions, Tanya, that you kindly asked us, is that everything we do is active. So ranging from the traditional liquid products to obviously the equities, fixed income, and infrastructure. But increasingly, we are developing within the private markets offering, in particular around private debt, and as one of the leading positions that Guernsey and the team has been leading is around sustainability, which I'm happy to expand a little bit if I may. So if you think about what's happening, kind of we call emerging, appreciate people may have different views, but something like, for example, digital currency, carbon trading, the fancy items, which probably definitely beyond my expertise, and increasingly the ESG sustainability related. Now, some people may say, actually, for those funds that integrate ESG may not be classified as an asset class. I tend to agree, because going forward, all funds will be ESG integrated. What will differentiate us, in my humble view, is the impact as well as the returns, which including the financial returns and the positive E and S outcome. And Rosie and Eric and the team has done a lot of work supporting real economy. But it's very important that we understand where the direction of travel is going. Committing net zero will mean nothing without supporting the challenging sectors and the challenging countries, in particular around the emerging markets. We're not talking about things that say no fossil fuel, but simply the key sectors like power, building, mobility, industry, agriculture. These 5 capital-intensive sectors representing 90% of the global emission. Think about it. Right? You don't have to be in emerging markets to think about these sectors. So this is where Guernsey and the team, as part of their innovation push, is positioned Guernsey as a place for innovation and solutions. This is where we want to be part of it, and this is where we understand the challenges to quantify, to have a real impact, to avoid greenwashing. But if we do it well, the transition premiums are there. And if we do it well, we have a chance to achieve net zero. Otherwise, I think we are kind of in our own dream to have this kind of great, mission.
But one of the things that have come up in that context is if you have investors who have an aspiration to help the planet, that's one thing. But they need measures associated with that, and they need a return. That's what they're looking for. They're not looking to go for a smaller return necessarily. And as you've said, and I observe this always to be the case, that this is becoming much more mainstream. It's not a question of having a sustainable fund or ESG. Everybody's going to be into ESG. So what about these measures that you put across things? Do you think that the financial world is becoming less opaque about how they put some sort of metrics across a fund in terms of its sustainability?
First, I'm so grateful that you asked that question, because this is where the dilemma comes. One of the key dilemma is that if we truly support transition, the current, vanilla decarbonization targets does not work. Because one simple thing is that you have lots of investors sending signals saying, my portfolio is nice and clean. But decarbonization of portfolios does not equal decarbonization of the real economy. So this is very important. Second is that the current policy and the measurement or target-related work does not really support transition. Except last year when G20 was hosted by Indonesia, China and US co-chaired the G20 work. For the first time, they understand actually, if you support them, assuming you're backing the credible firms and credible countries, your target actually may shoot up short term, but over long term it should come down. But again, we do not have the answers yet, but we must ask that question. And that realistic approach, that programmatic approach, is where we all have to contribute. So to answer in summary, is that the work is ongoing, and we are involved, Guernsey Finance involved as a part of the G20 work. We are, providing the much needed bottom-up solutions so that ultimately the top-down supporting network can come and support us.
If I may add up, I think this is great that it's in the making, and there's those global conference that allow people to try to unify around a common idea. But if I look at our task for us, which is to make a return but also raise capital, and we have investors from North America, from Europe, from Asia, not everyone has the same perception of what Article 6, Article 8, Article 9 is as an example. And I've just looked at the way I raise capital in North America. I cannot put my ESG slide at the same place of the deck, otherwise I don't get a meeting.
Yeah.
And it's as simple as that. So it remained returns, but there's a need for a uniformized requirement.
Yes.
And it become extremely difficult to find that. I would say that common ground. Some people believe that if you pay less tax in certain country, this is not ESG compliant. Some other countries, this is how it is. It is very, very tough. So it's a great ambition, I think. But the first step for me will be to come back to realistic, deliverable
exactly.
For people that are in position like, of course, thanks to the influence of people in your position that are allocating larger amount into others.
It's really a teamwork, just one sentence. We are at a very important moment. If we're not careful, we're going to be victim of our own progress. Because it's not about religions or finger pointing. Doesn't matter what name you call, you have to be sincere. And you have to deliver what you're first supposed to deliver, which is financial return. Of course, build up with fiduciary and responsibility for the community.
Yeah. So I think this is why Guernsey, and we were hearing this earlier from Rupert, is very right to make this a key area of expertise and focus. If we could come back to you, Lawrence, I asked the question of Rong, and we sort of touched on it, about this returns. What you were talking about is two areas which simply have very high returns because of the shift to low carbon or hopefully no carbon. These are necessary areas.
Correct. I think in fairness, there's some very shrewd investors that have been investing in asset classes like forestry long before it was sort of, dare I say, fashionable and in vogue. I think there's definitely been additional inflows into that part of the market, but shrewd investors have been capturing sort of 15-20% per annum returns from that asset class for some time because of the combination of biological growth, which trees were definitely still growing 20 years ago, and they're still growing now, alongside some sort of land value appreciation, and then of course the yield from harvesting the timber. That felling trees is old as time in terms of an activity. I think what we must be careful of, though, as asset allocators or indeed fund managers or investors, is ending up in crowded trades for sort of subjective reasons rather than, back to Eric's point, the financial return for the clients is the ultimate sort of pinnacle of investment management. And there are pockets of the market that certainly sort of pre the Ukraine invasion were starting to look slightly bubbly, and if you wouldn't want to jeopardize the wider message and story from investors getting too concentrated in certain parts of the market.
Fair enough. Okay, Rosie, if I could come to you about this question of returns too. We are used to, in the supermarket, looking at organic goods and saying, well, they are more expensive, but I think that premium is shrinking, isn't it? And how are you experiencing that in your sector?
Yeah, I think that's absolutely right. I mean, ultimately, these new technologies that we're investing in are much, much more efficient than current methods of production, right? So you're not cycling crops through an animal. You're either using them directly or you're growing something directly for human consumption. So in terms of the potential for cost reduction, that's massive. It's just a question now of scaling up the industry. Like most companies in this space are still small businesses that are building out production capacity and scaling. So that will take a bit of time, but we imagine also, if you take into account that, as you say, the price of meat, animal products is rising because of all the pressures that industry faces, whether it's organic or less sustainably produced products, all of that is coming up. So at some point in the next 5-6 years, there'll be a meeting in the middle of those, and we expect the technologies that we're investing in to undercut the price of animal products in the medium to longer term.
Can you talk about a couple of the technologies that you're exploring right now? What are the hot fields?
Yeah, so one area that we're very interested in and have a few investments in this kind of sub-vertical is termed in the industry precision fermentation. So if you imagine a beer brewery or any type of industrial brewing process, basically, lots of companies are applying a similar process to create animal proteins like milk, just through microorganisms. So you essentially have a big brewery vat that brews these real animal proteins, but through the microbes themselves, so you don't need a cow to produce milk anymore. Sorry, I know Guernsey is very big on the Guernsey cows. We'll still have those, by the way. This is more for the big.
Can we move on to another technology apart from precision fermentation?
We see this replacing the big industrial, very detrimental livestock facilities that is the vast majority of production now, which is very different to your free-range Guernsey cow. So yeah, imagine that at scale, and the efficiency of that, to your point on the price question.
And you've talked about scale. Just explain a little bit around that. I often hear that in the context of these types of foods. What do you mean by that? Why is scale so important in that context? You don't imagine it, because you imagine it be so sort of micro. You wouldn't imagine that scale.
I mean, this is a $5 trillion global industry that needs disrupting, and there's going to be 10 billion people on the planet in no time at all. So the scale that's required to make a meaningful dent in that food supply is huge.
That's a very interesting point. The size of the food industry is so great. The size of what you're disrupting is so enormous that the potential is enormous.
Yes.
That's what you're saying.
Yes, exactly. And where, 5 years ago, what we're investing in may have been seen as niche, I think today there's a growing realization from investors and our LPs that it is a multi-trillion-dollar global industry that is in dire need of innovation. And yeah, that's starting to happen now.
Eric, if we can come back to you again, we were talking at the beginning about finding creative ways, which is what you've been doing in Guernsey, to structure this in order to entice investors, really, and give them the security that they want. What other fields are you looking at in terms of offering that security? Is that a central theme that affects much of your thinking?
I think if I understand your question well, there's the there's certainly the type of products that you are offering in order to make sure every stakeholders
Yes.
don't feel.
I mean, there is
operates
unquestionably
into it.
a shift in investor thinking. That's what I'm getting.
There's a shift in
Yeah.
investor thinking. There's still more and more an approach to investing within boundaries. If I look at our new fund, we're setting up a Fund 4 now on our early growth strategy. We have a Singapore, Luxembourg, and Canadian vehicle run with a Guernsey investment advisor. So it just gives you a sense of how you need to be agile now to make sure that you are respecting everyone's needs in terms of commitment, and you might deal with sovereign or institutional. They all have their different laws. So I think you need to be creative on this, and this is where Guernsey has been quite good, because you have people that have been running funds. Should they be American? Should they be Asian? Should they be from the Middle East or across Europe? And I think you're really able to find the right skill set to help you on that. But the market is currently more and more divided, and Brexit was an example of it, but you can see that there's silos that are being created across geographies, and is the agility of your team when it comes to structuring and thinking about things. And it goes into other products as well. We have a digital asset fund as well. There's a number of jurisdictions that are still not allowing these type of products to operate in, and that would be certain advisors, certain auditors in certain countries from the same firms that will not accept to do it. So you have to find some agile way to go around innovation and new products and new fields that are evolving despite the jurisdiction you're in. And you have this also in food tech. Singapore is more advanced than a lot of other places.
Yep.
And you certainly need to have that flexibility of going where the innovation is and not be restricted to the boundaries that the environment to which you are imposed on you.
Fascinating. We have 1 minute left, I think even minus 1 minute, but because Rong's there and she has very strong links to China, back and forth all the time, and that's where you're from originally, we have 1 minute to talk about how China is going to affect and what's going on in China. So when I say what's going on in China, what I'm talking about is the increasing grip of autocracy there. I'm talking about the fact that the market has opened up suddenly, very rapidly, having been locked down. What are we to interpret from all of that in terms of the effect it will have on Western markets?
Thank you so much. And very quickly, I think if people think that soon we will have no geopolitical tension, I think that's definitely not happening. And you will continue for a long, long time. But ironically, I was chatting with Tanya at lunch. Is that with what's happening, from the US SVB to the Europe, for example, the banking challenges. Ironically, China, given where they are, both from a development, geographic, as well as a sectorial growth point of view, they actually providing a very interesting hedge, for programmatic, non-political investors. Now, this is not because I'm Chinese, okay? Please, I have a Pan-Asian face. I also do Japanese yen as well, and a Korean, most likely. But it's very important that we take a very programmatic approach when it comes to China, because think about it, Chinese economy this year is on target to deliver 5% growth. How many countries in the world can do that? Of course, India is the future later on. But for now, China matters. And no country or no region is perfect. If you think that there's a governance issue for China, there's a governance issue for everywhere. So it's very important that we understand that we work with those countries, those sectors, and those companies, but understanding the growing themes that are representing very appealing investment opportunities, especially under the sustainability, the mobility, electric vehicle, all the battery storage, all the things are happening, which we remain very positive. Last but not least, the Chinese currency. Now, people think it's not going to happen in our lifetime to really rival US. Maybe, depends on how long you want to live. But it's really important that we see that if there's one currency has a potential, it has to be renminbi. But it's providing, again, the hedge for central banks. It's providing that dual pricing in commodities, from traditional energy to soya beans, all the things that you may want to think about. So in our lifetime, it might happen. But it's happened in a way that only investors yourself getting the professional help can tap into these growing markets. And we hope together to be valuable. Thank you.
And I can really agree with that. I mean, my two kids speak Mandarin since
really?
a very, very young age, and they continue to do this. We have, over the last 3 years, moved our subsidiary in Hong Kong to underneath a Singapore one to be isolated from geopolitical risk. But if we've not shut it down, it's because we believe in the future of it. And I think it might move very quickly. I mean, things move so fast right now. And I think we've definitely not cut any of the possibility to invest there. But it's a market where you need to be prudent. And the other one is also the UAE, where we're opening, we have opened now offices in Dubai and Abu Dhabi, where we have people present locally as an edge to how the market is moving.
Yeah.
But clearly China is back, and I think it's time to take some early move, but you need to be extremely prudent from a geopolitical standpoint, because not everyone is aligned
Exactly.
on how to deal with it. So.
Thank you very much indeed. Eric, Rosie, Rongrong, and also Lawrence. Thank you, all of you.